Hey everybody, I'm John Van Duzer, CPA and partner, and I'm here with Suzanne Forbes, our managing partner and fellow real estate team member. And we're going to talk all about estate taxes to conclude our series on estate tax planning for real estate professionals. Thanks, Suzanne, for joining us.
Thank you. I'm glad to be here.
Yeah, so let's talk about our favorite topic, and I'm saying that facetiously, estate taxes. And I think, as we're filming this video, the estate tax environment is in flux. And so we're going to talk about that a little bit, but figured we could take a step back and maybe talk about the estate tax in general, where the law stands today, and then we can kind of conclude with, what's been slated and where it's going. So the estate tax, is a wealth transfer tax, right? When you pass away, if your net worth exceeds a certain threshold, you owe a tax on that net worth. And so there's a variety of strategies to basically, you kind of run the calculation. Is it in your estate or out of your estate, right? And so there's a variety of strategies to reduce the overall value of your estate or your overall estate tax at the time of your death. And so really sophisticated estate plans will take advantage of these strategies to really minimize that tax calculation. So I figured one of the first things we could do is just talk about gifting and what the whole purpose is and why that becomes important in this context. So when you think about gifting, what's kind of the initial start of your approach on gifting and really how to approach that?
Well, the first thing we try to do is to sit down and look at the total estate value right now. So currently, under the current law, the exemption is, I'm just going to use a little over $11 million per person to be able to, so if you have a spouse, the both of you can get 22 million and be able to die with those assets without an estate tax. That is what's on the chopping block right now. There's a lot of conversation that's going to drop down to 3.5 or 5 million. And so the idea here, and with real estate, with the growth in real estate, you can hit those thresholds pretty quickly if you're talking about a $3.5 million threshold.
Absolutely.
So the key here is to figure out what assets do I have right now and that I could gift and still retain control of, which we can. You can do that. You can still gain control, but I could gift them that are going to explode in value. That today they're not maybe worth a lot, but when I get done building it, when we get done, building it and leasing it out and getting it fully occupied, the value of that assets. I might have a raw piece of land today, and then I'm going to put, build on it. That when that gets fully leased out, it's going to be worth a lot of money, and especially if it's in an area. So what we look at is we look first at what is the total estate value, what are those high assets that you have today that are going to be worth a lot in the future, and what's the best way to possibly transfer those assets so that the increase in value, if I have something, a piece of property that I bought for $500,000 today, but by the time I build it out and I lease it out, it's going to be worth $3 million. How can I get that difference between the $500,000 and the $3 million out of my estate so it won't be taxable at a potential 45%? Where, if you had a state tax of like a state as in Florida state, which we don't, but if you add that in, sometimes we could be looking at excess of 50% just in a transfer tax going to the government. And you want to keep that preserved. You don't want that to happen. So those are the gifting strategies that we start with, is what's the value of your estate, what assets do you have, what assets are going to be highly appreciating, and then what's the best way to potentially get them out of your estate today.
Yeah, absolutely. And then you touched on it, once you identify, okay, I have this piece of land, I think in the next 10 years, there's going to be an interstate interchange, right next door to this piece of land. And so the value is going to go tremendous from what's agriculture today to, commercial development. This would be a great asset to gift. Now you need to start making decisions on how are you going to transfer these assets. And this starts to be where you start to maybe look at what your goals are or what things are important to you. Option one is an outright gift, right? I can say, okay, here you go, kids. I'm going to put this in an LLC. I'm going to give you the interest to the LLC. Here you go. Good luck. Hold on to it for 10 years. You really should. I think it's worth a lot, right? And the risk you run there is they say, great, Dad gave us this piece of land. I'm going to sell it and I'm going to go spend it. And it's going to be a wonderful next couple years for me. And that's the risk you run with an outright gift, right? The donee has 100% control. They can do whatever they want, and you can really, end up in a situation where they're doing something that you didn't really contemplate or want them to do. So a lot of people then will use trusts, which is, like you alluded to, a way to maintain some level of control, even if it's maybe indirectly, but still transfer the value and the economic benefit to the next generation. And so one of the first things I figured we talk about is, just a really basic irrevocable trust, or a complex trust, or a GST exempt trust, a trust that's basically set up. You make outright gifts to it, and the benefit there is it can remain in trust for a long time. And so, Suzanne, I know you and I in the real estate world see a lot of these. What's kind of your experience with just kind of a basic irrevocable trust?
We do see a lot of trust, and typically what we will see is we may take that property and you put it in an LLC, and you have voting and non-voting shares of membership interest in that LLC. So if you did decide, before we get to the trust, but if you did decide you wanted to gift outright to the children, you could gift the non-voting interest to the LLC. And that's a simplified way of doing that, where you would retain the voting interest, so you control whether that property gets sold and how distributions are made, but the children still, they own the 99% of the non-voting interest, and you own the 1% voting, and you control everything. So that's a very basic, and sometimes we'll use that technique if it's not a lot of assets, not necessarily an operating trade or business, not where you're getting rental income and all this, and because of other issues from a tax consequence. So then the next step is, typically what we'll do is those assets will still be put in an LLC, but the LLC interest will be gifted to a irrevocable trust. Mm-hmm. And now this is irrevocable. So once you draw up that trust document and you say, here's what is going to happen to these assets, and here's what happens to the income stream, you can't change your mind. And I think that's where sometimes people get stumbled a little bit. That's the stumbling block. So you have to be prepared to ultimately change, and you can still retain, in my example, the 1% voting interest in that LLC. So even though you may not be the trustee of that trust, you basically control the assets in that trust, because you're retaining control of the interest. But you put them in the trust, and what happens is that you make a gift of the value of those assets at the time you put them in the trust, which is a lower value. We would spend all day. This would be an 8-hour series if I try to talk about discounting and all these different things. But there's actually ways to be able to take, for example, $1 million of value and discount it and give it to the trust, because of what we call lack of marketability and transferability and control, etc., and maybe only have to be valued at less than $1 million. Right. And so there's ways to do that. So those are things that we look at, so that if I could give away $1 and only have to say that I've used 70 cents or so on, or thereabouts of my gifting exemption, that's better. So you put them in the trust. The trust now has its own identity for estate purposes, for transfer tax purposes. So we're a little bit of a geek. I like my geek thing. It's kind of cool, because in the tax law, I know y'all are thinking this is not really very exciting, but in the tax law, there are trusts that we can set up for transfer purposes, for estate purposes, that are a separate identity, and they're not included in your estate, and that appreciation is not included. But for income tax purposes, they're as if they don't exist. Yep. And that gives us a lot of opportunity.
And so that's kind of the next thing we'll talk about. And just to kind of close the circle on the standard irrevocable trust, they can also be set up to be multi-generational, right? You can set, and I see this a lot with a family office or a large portfolio. You can set these trusts up where they can transfer to your kids and your grandkids and your great grandkids as each person goes to the end of their life. And so it can be something that's set up and contemplated really to leave a legacy for your family, and you're taking care of the gift taxes once, and then you never have to worry about those again. And so that's one thing to think through. And then, as you're talking about now, as we delve into the realm of what's called a defective trust, again, is really neat, because it's valid for estate tax purposes, right? But not valid for income tax purposes. So you have this separate entity, and it has a separate identity, and you get things out of your estate, But then for purposes of income taxes, you still pay taxes on the income, or you use the income or loss as part of your tax calculation. And so it's a flow through type entity for income tax purposes. So what has been your experience with those sort of trusts?
These trusts have been extremely beneficial because if the trust itself, maybe it owns an asset that generates taxable income, and because the asset, so the income will go into the trust and appreciate in value and continue to grow. And then if you have a taxable estate, you, because the income flows to you on your tax return, you pay the taxes for
Right.
the trust, and it's not considered a gift.
Yep.
And so, I mean, that to me is even more beneficial because I'm in effect paying so the assets inside the trust can grow in effect tax free. They're not tax free, but the taxes are being paid by you, and the assets can continue to accumulate inside the trust. So I think that's really important. And when you talk about these generational trusts, that's kind of what I mentioned earlier about being able to control things beyond the grave, right? So you're able to set that legacy up. You'll be able to tell when you pass, you're still controlling what happens to those assets and who gets the income and what, you know, that they can get the income for their lifetime, but then the assets will go to the next generation and what they will be able to do. So you really are able to set that legacy up, which a lot of people want to be able to do with these assets that they've worked very hard for all their lives to build and be able to put them in those trusts. So that's where we see multi-generation trust, but we also do see and these defective trust or disregarded trust for income tax purposes, we can make them where they are separate taxable income tax for income tax purposes if we need to, and then when
Yeah.
you pass, they do have their own identity for income tax purposes there. So it gives us flexibility to be able to determine what's the best accomplish, you know, but how do we accomplish your goals with being able to meet your personal goals and what happens to the assets with a most minimal tax impact.
Yeah. And the other thing about the defective trusts is they're used a lot to do what's called an estate freeze, where essentially you can sell assets to the trust, right? The typical defective trust will be funded with a decent sized gift, and then assets will be sold to the trust as well. And you take back a promissory note with a standard interest rate that, you know, it's prescribed by law for it to be legitimate. But then what you do is you pay those payments to you as the seller. For income tax purposes, you can't sell things to yourself, so the payment of the sale and the interest and everything is a disregarded transaction, so it's not a real transaction for income tax purposes. But what that does is it controls the increase in your estate, right? Because you may have a 5% interest rate, your estate is growing at 5%. However, you are able to sell the piece of land that is going to have an interstate interchange, right? And is going to explode in value. And so the rate of return on your trust may be 20%, where you've pushed all that into the trust, and the trust is getting the benefit of that growth and only paying down the nominal interest over your lifetime. And then you're also paying taxes on the income, which means you're spending your assets down even more. So you can see where if you think this through ahead of time, you can really do good in getting a big dent in the value of your estate just by using the strategy of, let me freeze my estate, let me slow down the growth, let me move the high value assets over, let me pay the taxes on those assets over my lifetime and deplete my assets. So that way, you know, when I pass in a really long time, you know, all the value is sitting in the trust. Another setup that we see quite a bit is called a SLAT, spousal lifetime access trust. Suzanne, have you seen those in your practice?
I have seen quite a few of them. They are typically used for our very high wealth individuals that are trying to use up this $11 million exemption because I know we're gonna talk a little bit about the new tax proposals out there. What we don't have an answer on right now is if I gift 11 million today and they drop it down to 3.5, is there going to be a clawback saying,
Right.
okay, you already gifted, you know, is that going to pull back into your estate? We don't know, but if there's any chance that there's not a clawback, we want to maximize that 11 million. And so what happens now is, well, we want to maximize that all out, but I still want to have the income to be able to live on, right? I don't want to, I want to give it all away to get it out of my estate, but I'm living on that income. And so I'd like to keep that income. And so what we have is on these slats, on these spousal trusts, is they split the assets and they give them to the spouse. So you give half to one spouse, typically one half to the other. And that spouse is allowed to use that income from those assets during their lifetime to be able to live. Mm-hmm. And so in effect, you're getting to, as the husband and wife or the spouses together are able to use that income during your lifetime. Now, when one of the spouses passes, the income will then go to their heirs, and so your income would be cut in half. But that's why you don't give it 100% away. Now, the difficult thing is I have to sit with clients when we do this and explain what would happen in a divorce, because if there's a divorce, you're not going to get half that. You've given away half of those assets, and so that's always a difficult situation, because as professionals, remember I said I'm an optimist, but you still have to say, let me tell you what would happen, and then you have to let them talk that through, and that gets a little awkward sometimes, but usually there's a large amount of assets, and even in the case of divorce, the spouse could live on half the assets if they did not have access to the other. So I think that's really it's a very a highly used technique that we are seeing a lot of right now.
Yeah, and I think that's probably one that's really in style right now, because it does give you that flexibility of, if you need the assets as a married couple, it creates a mechanism where you can have that access. Again, you just have to be really wary of, what happens if there is a divorce or there's an early death, making sure all your eggs aren't in that basket, so to speak, and that, you've kind of diversified a little bit, but it is definitely a very good strategy. And then, when we work with clients and they say, hey, I've done the irrevocable trust, I've done the defective trust, we set up a slat, we still have a problem, are there any other strategies? That's really where we start to take a deep dive and really look at sophisticated strategies and valuations, discounts. And then one of those strategies is like a GRAT, a grantor retained annuity trust, where you can make a transfer but take back an income stream over a period of time. And again, the value of the gift is really dependent on the spread on the rate of return of those assets versus the IRS annuity rate that you discount the gift by. And so what can end up happening is you can give a gift and it has a nominal use of your estate tax or gift tax exemption, $100,000. But if you have a really high rate of return on those assets, you could be gifting millions of dollars. The catch is that it's 10 years from now, and you have to live the entire 10 years for it to actually work. So if you find yourself in this situation where you have issues, it's really worth having a conversation and really working through a plan to make sure that you're really covering your bases. So the last thing to talk about is, there's a lot of people that say, hey, great, I want to set up some things for my kids, but I have a vast amount of wealth, and maybe I have some other ideas of how or where I want that wealth directed to. Suzanne, what's been your experience in this area?
Yeah, and most of those times it's related to charitable giving. And so they may have an interest that some charitable interest that they have specifically on. And it's interesting because, so let's just step back. If you donate assets, give assets to charity upon your death, they're not included, you get a deduction for it. So they're not included in your estate. So you can just say, when I die, I'm leaving anything in excess that's going to be taxable to a charity, and that will reduce your taxes if you've already set up all of this other stuff. But I also think it's interesting, one, that maybe you want to see the benefit that charity could get during your lifetime to see what the impact you could have. And two, if you're in a high income tax bracket, what about a charitable deduction? Is there some benefits that you could use there? And so that's where we'll see charitable trust set up. And there's annuity trust, and there's remainder trust, and there's all sorts of charitable trust type of giving. So you can just do a very basic where you do charitable giving out of your estate at the time of death, or you can set up a charitable trust now, and you can either put the assets in a trust and you can get an income stream off of them, or you can leave a remainder. So there's lots of different ways that you can do with these charitable trusts, and you get some value of a charitable deduction today from an income tax standpoint. Because remember, we have two different sets of tax laws we're dealing with. We're dealing with the estate transfer tax, and we're dealing with an income tax. So we will see charitable giving being done now through trust, and being able to set them up so that you can get a benefit now. And more importantly, you might get to see something during your lifetime with those funds being used for those purposes that you're passionate about. And so I like to always, find out what are your goals there that you might have.
Yeah, no, that's a great point. And again, as you're looking at things, it's just like income taxes. You can minimize taxes, but really what you want to do is look at the big picture and identify what are your goals and what are the things that are important to you. What legacy do you want to leave, both for your family and your community? These are all the important considerations that you want to have kind of rolled up into your plan. And so real quick, and we'll transition our conversation a little bit from gifting and just talk about the current environment. And so when you do pass away and assets are in your estate, kind of the one gimme that you get or the benefit you get is called a step up. Can you explain kind of in concept of what a step up is? And then we'll talk about new tax law, and we'll explain why this is important to understand what it is.
Sure. So I like to use the example, some people know, but I grew up in the Florida Keys. And so let's just say that my dad bought the house in the Keys back in the early 70s. And that house, when he bought it, he paid $100,000 for it.
Mm-hmm.
And today, that house is worth $1 million because it's on a canal. And he says to my sister and me, I want to give this to you. So I'm going to change the title on this house and put, you and your sister's name on it. And I say, Dad, I love you. I said, and I appreciate this, but do not give it to me, because he's 92 years old, right? And I said, I would rather inherit it because I'm a CPA. And I know that if you give it to me, that house for $100,000 that's worth $1 million, if my sister and I decide to turn around and sell it tomorrow because we have we can't afford insurance down there or whatever, okay, we're going to pay tax on a $900,000 gain, the difference between the $1 million and the $100,000 he paid for it. So
Right.
My basis in the asset when I receive it as a gift is whatever the person that's giving it to me paid for it. However, if I inherit it, I get what's called this step up in basis. And now my basis, my cost basis for purposes of calculating that gain, is the fair market value at the time I received it. So that house now comes to my sister and I at $1 million. So if we turn around and sell it tomorrow, that's if I inherit it. If my dad passes away and it goes through his trust that we've set up and it's in the name of his trust, and it comes to us through his trust or as a direct beneficiary, then now my cost basis in that asset is $1 million. And I turn around and sell it tomorrow, I have no taxable gain. And so that's the theory of the step up. And the reason why is because if that asset is part of my father's estate, and let's say he had a taxable estate, he might be paying in a state for estate purposes. If he hadn't had a daughter as a CPA and helping him, he might be paying 45% tax on an estate tax transfer, or 40%, maybe 45. The rates are going to go, we don't know where the rates will end up. And so the idea is that gimme is, okay, you paid the wealth transfer tax, and so now the heirs inherited at the fair market value, the value that you paid the estate taxes, because estate taxes are paid on fair market value, not on cost basis, but fair market value. And so that's the theory behind the step up on basis.
Yeah, and the one significant point in the context of a real estate professional is that also applies to starting over on depreciation. And so we actually had a client that passed away. He owned a lot of student housing, and we were able to make elections on his tax return basically to start over on the depreciation, and the depreciation deduction on that portfolio for his heirs that was extra based on this step up was 6 figures a year. It was massive, and it was a benefit, and is really helping the heirs reduce their income tax consequences or capital gains, on the event of a sale down the road. And so we kind of go over that really to talk about where we're at today. So today there's a new administration. They've recently released kind of their press release on their vision for our taxes in the future. One important note is the White House can't unilaterally change tax law. That has to go through Congress. In Congress, you got 500 people with 500 different opinions, and so we expect there to be a lot of horse trading and negotiating, and I don't think the White House will get 100% of what they want, but really want to start the awareness and the thinking of the things that they're proposing. So Suzanne, why don't you walk us through maybe a little bit of what their proposals are in the estate tax context, and then we can kind of talk through the significance of that.
Sure. And mentioned earlier the exemption amount. So the assets that you can die with, and it's over 11 million because it gets indexed for inflation. So some of the proposals are to drop that down to 3.5 million or 5 million and not index it for inflation. So that's number one. So if we're looking at anybody that might, and especially with real estate with large assets, many times what the fair market value of the estate would be. Now you do get to back off debt. So if it's a heavily leveraged asset, you do reduce it by the debt amount that's on those assets. But that's a big, and what we don't know yet is, well, let's say that I gift it all away. I gifted 11 million and it drops to 5 million. What happens to that $6 million spread? Does that come back into my estate when I die or not? And we don't have that answer, but we do know that if you haven't gifted it, then we do know it will be in your estate. So you need to try to be as proactive as possible. The other area I just talked about, step up, where you would be able to get your cost basis would now be the fair market value. The proposal is to remove the step up for, I think, assets in excess of $1 million. How that would play out, we have no idea, but that would be very, very significant. And that's probably the one thing that holds back people right now from gifting versus inheritance, is because they want their heirs to get that step up.
Yeah.
So that's sometimes when we're talking about gifting things to these trusts, everything we've talked about, sometimes the reason why people say, ooh, if I've got a bunch of stock or real estate that I bought a long time ago and I want to be able to get my heirs to get the step up, that's one of the considerations. But if the step up goes away, then that's no longer a reason not to gift, other than maybe having the income while you're alive. So that's another area. That step up is really, really significant. When they talk about lowering the exemption, that's one thing. But then when you talk about really an effective double taxation on those assets, because you're paying an estate tax, a transfer tax, as well as an income tax. If you're in a high tax bracket at proposed 40% and you pay a proposed, the other thing is that they're also proposing to increase the actual tax rate for the estate tax. So between those things, you could be looking at a 45% estate tax, potentially even higher, and maybe a 43.8 or higher tax rate. You do the math, that's more than 80% of the assets going to taxes. And that's obviously not what people have worked for. But these are some of the things that are on it. So I want to say you cannot wait until the law gets passed to do this. Our attorneys friends have already said, you get to October, they're not going to be able to take on new clients. There's no way there's enough people and resources to come up with a plan before this law gets changed. We have to come up with plans now, and whether we actually have them vote, do them. And I sat on a webinar yesterday. They were talking about whether or not, if you did the plans, whether you could retroactively remove them. And some attorneys think you can, that you could undo them. And but there's just, this is such a big area, and our attorney friends and us as CPAs, there's just not going to be enough time in the day if they don't pass, whenever they pass this. And the other thing is that if they make these changes, we don't know if they're going to be retroactive. So will they be effective January 1st, 2021? We don't think so, but we don't know. One proposal is to be retroactive. Would they be effective the date the law is changed? So if they pass this, in September or whatever date, does it become effective on that date, or does it become effective January 1st of whatever the next year is? If it gets passed in 21, does it become effective January 1st, 22? We don't know. we have no idea, which is very sombering.
It is, and it's a challenging environment to plan around. But like you said, I think the most important thing to take away from this is the people that are prepared and the people that are thinking through these things and the people that are doing this all in advance are the people that are going to be able to react and adapt and navigate this environment better, right? If you wait until the last possible second and then try to do something, you may find yourself out of luck. Which is not where you want to be, especially when the stakes, I don't believe, have ever been higher. You know, and the changes have never been this sweeping. So it's a big deal. So that's all the time we have today, Suzanne. Thank you so much for all of your time and wisdom and going through this series. If you ever have any questions or anything, you know, our firm is always open to discussing that, and if nothing else, talk with your tax advisor and your estate planner and find a competent attorney, and make sure that you're thinking through all these things because they're very important. So thanks, guys.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.